the Inspired Podcast, your home for financial education, business growth, mindset, and, well, a whole lot more.
I'm glad to be here.
Today, we're doing a deep dive into the 2008 financial crisis. It feels like yesterday sometimes, but it was a moment, wasn't it, when the whole global financial system just nearly went over the edge.
Absolutely. And our main guide for this exploration is Andrew Ross Sorkin's incredible book, Too Big to Fail. It's subtitled, The Inside Story of How Wall Street and Washington Fought to Save the Financial System and Themselves. Quite a mouthful, but it really delivers that inside story.
It really does. And our mission today isn't just to list events. We want to pull out the really crucial insights from Sorkin's work. You know, what happened behind the scenes, who were the key people making impossible decisions under, well, unbelievable pressure.
Exactly. We want to understand those frantic, closed-door actions and figure out what the lasting impact has been. Because, let's face it, the ripples are still felt today.
Okay, so let's kick off with a moment that Sorkin captures brilliantly. It's September 13th, 2008, the day before Lehman Brothers actually collapsed. Jamie Dimon, CEO of JP Morgan, he holds this conference call. And what he laid out, it wasn't just, oh, Lehman might be in trouble. It was way bigger, right? Almost prophetic.
It really was. What's striking, looking back through Sorkin's account, is how early Dimon grasped the systemic nature of the threat.
Yeah.
He wasn't just focused on Lehman.
Right.
He told his top people, basically, get ready. Not just for Lehman, but potentially for Merrill Lynch, for AIG, Morgan Stanley, maybe even Goldman Sachs filing for bankruptcy.
Wow.
He saw the interconnectedness. It wasn't just that they did business together. It was the specific complex assets they all held, these derivatives tied to mortgages. He knew one failure could trigger, well, a cascade.
It's almost chilling how accurate he was. And bam, the next day, Lehman Brothers files for bankruptcy.
Yeah.
Can you kind of walk us through the final moments for Lehman? It wasn't a simple case of running out of money, was it?
No, it was complex. Richard Fuld, Lehman's CEO. He'd been there forever, a real titan. But Sorkin paints a picture of someone perhaps initially downplaying how bad things were. Maybe denial, maybe hoping for a miracle. They were desperately trying to find a buyer, raise capital. There was that potential deal with the Korean Development Bank that fell through. Sorkin suggests Fuld's, let's say, negotiating style and maybe underestimating the sheer urgency didn't help matters. They just couldn't secure the lifeline they needed.
And crucially, the government decided not to step in this time, which was a big deal, especially after they'd helped orchestrate the Bear Stearns rescue earlier that year. What was the thinking there?
That was the pivotal moment. There was definitely a feeling, particularly at Treasury under Hank Paulson, that, they couldn't just keep bailing out private firms, this idea of moral hazard.
Right. If you know you'll get rescued, you take crazy risks.
Exactly. The thinking was, maybe letting one fail would send a message. The problem was, Lehman wasn't just any firm. Letting it go unleashed absolute panic. It proved Dimon's point about interconnectedness in the most brutal way.
And wasn't there something about their accounting? Repo 105?
Yes. Repo 105. Sorkin touches on this. It was essentially an accounting maneuver, a way Lehman could temporarily move assets off its balance sheet right at the end of a reporting quarter.
To make things look better than they were?
Basically, yeah. To make their leverage seem lower. It just highlights how sometimes the numbers you see don't always show the full picture of the risk involved.
Okay, so that interconnectedness you keep mentioning, it sounds like the absolute core of the problem. How deeply woven together were these giants?
Incredibly deep. The main threads were these complex financial products, mortgage-backed securities, for one, banks packaged up home loans, including lots of risky subprime ones, and sold slices of them. But then they also bought and sold insurance on these things, credit default swaps, or CDS. So Bank A holds risky mortgage bonds. Bank B sells them insurance via CDS. But Bank B might also hold similar risky bonds, or have sold insurance to Bank C, who holds bonds from Bank A. It becomes this tangled web. As one analysis put it, reading Sorkin, they were all eating their own cooking, holding vast amounts of the very risky stuff they were trading.
So a failure in housing doesn't stay in housing, it rips through this entire financial network.
Precisely. Which then forced the government's hand in ways few could have imagined. Unprecedented intervention.
Let's talk about those government players. Henry Paulson at Treasury, he came from Wall Street, right? Goldman Sachs CEO. How did his approach change?
Paulson's journey is fascinating. Coming from Goldman, his initial instinct seemed to be, let struggling firms fail. sink or swim. Sorkin has this great anecdote. Paulson apparently felt like he wanted to vomit when Jamie Dimon upped JP Morgan's bid for Bear Stearns during that earlier rescue. Shows his initial distaste for bailouts.
Yeah.
But as the abyss opened up after Lehman, seeing the potential for total meltdown, his stance shifted dramatically. He became the driving force behind the huge AIG bailout and then pushing for the Troubled Asset Relief Program, TARP.
A massive shift. He must have been under incredible scrutiny given his background.
Absolutely. Walking a tightrope, constantly accused of favoring his old Wall Street colleagues. Immense pressure.
And Ben Bernanke, the Fed chairman, his role felt a bit more behind the scenes compared to Paulson or Geithner.
True. Bernanke wasn't always the public face in the frantic deal-making moments, but his role was absolutely critical. He's an academic, a deep student of the Great Depression.
Right.
That historical knowledge convinced him that the risk of inaction was catastrophic. He provided the intellectual justification, the economic argument for why they had to intervene so aggressively, even if it felt wrong on principle. He feared a complete economic collapse, far worse than the 30s.
And Timothy Geithner, who was then head of the New York Fed, he seemed to be right in the thick of it.
Oh, Geithner was the point man on the ground, constantly on the phone, brokering deals, sometimes practically banging heads together. Sorkin describes him as incredibly active, trying to stitch together solutions, pushing mergers.
Was it their nickname?
Yeah, apparently some bankers jokingly called him eHarmony because he was always trying to force these struggling firms to pair up. His style was described as forceful, maybe even abrasive at times, but it reflected the absolute desperation of the moment, trying to keep the gears from seizing completely.
Meanwhile, Jamie Dimon, who saw it coming, JP Morgan seemed to navigate it better than most, even picking up Bear Stearns.
Dimon at JP Morgan definitely came out looking stronger. His early grasp of the systemic risk was key. Acquiring Bear Stearns, yes, with government urging, but it was a strategic move. Interestingly, even though JP Morgan took TARP money later, Sorkin notes Dimon felt it was, quote, asymmetrically bad for his bank, basically. He felt forced to take it for systemic stability, but it hindered JP Morgan from potentially capitalizing even more on weaker rivals' failures.
So all this intervention, saving AIG, which was enormous, really cemented this phrase in the public mind, too big to fail. What does that really mean, and why is it so controversial?
It's the idea that some financial institutions are just so large, so interconnected, that their collapse would cause such widespread economic damage that the government simply cannot allow them to fail. They feel compelled to step in.
A safety net, but only for the giants.
Essentially, yes.
Yeah.
And that's the controversy. Does it create that moral hazard we talked about? If you know you're too big to fail, do you take on even more risk, knowing taxpayers might foot the bill?
Right.
And is it fair? Why should these behemoths get rescued when small businesses go under every day? It raises fundamental questions about market discipline, fairness, and frankly, the sheer power these institutions wield.
It's a dilemma we still grapple with. Sorkin's book isn't just about policy and finance, though. It's full of human drama. What are some of the moments that really show the people behind the headlines?
Oh, definitely. Sorkin excels at this. You get Fuld at Lehman, seemingly projecting confidence even as the ship is sinking, this almost tragic figure. You feel Paulson's immense stress, the physical toll it took. Then there's the almost legendary defiance of John Mack at Morgan Stanley. When apparently pushed hard by officials to sell his firm cheap, Sorkin reports Mack told them in no uncertain terms to, the quote is, get fucked.
Wow. Shows the raw emotion.
Absolutely. And contrast that with John Thain at Merrill Lynch, reportedly spending over $1 million redecorating his office just as the crisis was hitting peak intensity. The optics were not great.
Understatement of the year.
Yeah. And Paulson's report a warning to the Wall Street CEOs to just be helpful. You can just sense the tension, the implicit threat behind that word. It makes it all so visceral.
It really does. Okay, we're covering a lot of ground here. If you're finding this deep dive valuable, maybe take a quick second to like and subscribe to the Inspired Podcast. It helps us keep bringing you explorations like this into finance, business, and growth.
Definitely helps. So after the immediate fires were put out, Lehman gone, AIG saved, TARP passed, what were the big changes? The aftermath.
Good question. What happened next?
Well, TARP injected hundreds of billions into banks to stabilize them.
Yeah.
That was huge. And you saw a fundamental restructuring of Wall Street. Goldman Sachs and Morgan Stanley, the last big independent investment banks, converted themselves into bank holding companies.
Why was that significant?
It gave them more stable funding, access to the Fed's lending facilities, but also subjected them to more regulation, like traditional banks. Then came regulatory reforms, Dodd-Frank being the main one in the U.S.
Aimed at preventing this again.
That was the goal. More capital requirements for banks, rules around derivatives, a consumer protection agency, lots of things. But the debate still rages, Was it enough? Have banks just found new ways to take risks? Are we safer now?
And there's still disagreement on the root causes, right? It wasn't just subprime mortgages.
No, it's complex. Subprime lending and those mortgage-backed securities were definitely the spark. But many point to decades of financial deregulation, like the repeal of Glass-Steagall, which separated commercial and investment banking. Others focus on the role of Fannie Mae and Freddie Mac, the government-sponsored housing giants, arguing they fueled the fire. Low interest rates for years also played a part. Sorkin lays out the different arguments, the different players' perspectives. There isn't one single, simple cause everyone agrees on.
It feels like we see echoes of 2008 sometimes, even recently. Thinking about Silicon Valley Bank or Credit Suisse, even FTX in the crypto space. Are there parallels?
I think there are. You definitely see patterns. How quickly confidence can just evaporate, the hidden interconnectedness, maybe not always to the same products, but the same kind of systemic vulnerability. And often that same pattern of maybe initial denial or underestimation, followed by panic and calls for bailouts or intervention. It really makes you wonder, doesn't it? Have the fundamental lessons sunk in, or are we doomed to repeat these cycles, just maybe with different names and different assets?
That's a sobering thought. This has been incredibly illuminating, revisiting the 2008 crisis through Too Big to Fail. Key takeaways for me are just that staggering interconnectedness, the impossible choices people faced, the emergence of this too big to fail problem we still live with, and those lingering questions about future stability.
It really forces you to consider what's truly changed since then. Are the reforms enough? Where might the next vulnerability be hiding? Are we looking in the right places? It's an ongoing story.
Absolutely. And if you want a visual guide to help piece all this together, definitely check out the description below. We've put together an exclusive visual mind map covering Too Big to Fail and the wider context of the crisis. It's a great resource.
Worth a look.
Thank you so much for joining us for this deep dive into the 2008 financial crisis here on the Inspired Podcast.